Good afternoon and welcome to the I&M Group investor presentation, where we'll be covering our financial year 2022 results. And you will see the presentation that we will be putting in front of you covers a very colorful screen right at the outset with some butterflies that captures the various countries that we are operating in. And very importantly, the values that we espouse as an organization. So if we could get started. Seem to have a bit of a snafu with the rolling of the presentation, so bear with us. Very good. We're fine to proceed? Okay, very good. So we will just recap on what 2022 looked like for us. And certainly, as you will all be familiar, we had some significant headwinds, economic headwinds that we faced as a group in our different markets. And this coming, of course, on the back of the challenges that we'd seen over the past few years, recovering from COVID, certainly the geopolitical risks that were impacting the markets in which we operate. And while we haven't gotten to full recovery, it was certainly clear that elements like the rising cost of living due to the geopolitical events were hurting consumers in our markets. We have significant weather events that have also been impacting us. And clearly climate change is something that we have to contend with. And the impacts of that are being seen in one of the worst droughts that we have experienced in over 40 years. And this is leading to heightened poverty, and we are even seeing loss of life. We have also seen these challenges leading to challenges in the currency markets. We've seen the dollar strengthening against our regional currencies, and that has adversely impacted the environment in which we are operating, and led to some significant challenges for our customers doing businesses in our various markets. So this has also meant that as policymakers, the central bank, the governments have had to really strike a balance between monetary policy and fiscal policy in order to support all of the turnaround initiatives that different players in their markets are going through, while trying to manage inflationary pressure. But we have also seen some economic tailwinds that have supported our performance in the past year. We've seen the ongoing economic recovery in East Africa, and that has been projected at about 4.8% in terms of GDP, as business activities have taken the opportunity really to recover from the challenges of COVID, and even from the dislocations that we have seen from the geopolitical risks that I mentioned earlier. We have seen the confidence return into markets from the peaceful elections that we had in Kenya. We've seen improving economic and business environments in our neighboring markets in Tanzania, and also in Mauritius, where we have significant dependency on the tourism sector. We have seen that improve as well. So if we just recap quickly on our geographical footprint for our audience today, you will see that as a group, we are operating in 5 different markets. We had highlighted them with those colorful butterflies. But you will see also that we have a mix of businesses in our geographies. So our banking businesses in all the 5 countries in which we operate. But in Kenya, which is our home market, we have a mix of businesses alongside our banking business. So ranging from investment advisory and the Babbage Capital, our bank assurance business, and real estate, as well as our new entity, I&M Capital, which really provides the wealth management services that we have been offering to our clients. You will see in Uganda as well that we offer advisory services, but really I&M Babbage Capital actually covers all of these presence markets. So in summary, you will see that we are servicing over 350,000 customers across 83 branches in these countries. And we are a big employer across all these different markets with over 2,500 staff. And where we have listings, which is in our home market in Kenya, and in Rwanda, we have over 4,000 shareholders collectively that are really our partners as we grow the business. So we feel that the strategic aspirations that we had set out to achieve are working well for us, and we are on track to meet these strategic aspirations on the back of the performance that we had in 2022. And we will come to the strategy house in a short moment so that we can recap on those. But quick highlights on the panels that you see in the presentation there. On our strategy, we listen to the voice of our customers, and we capture this under the Net Promoter Score, which shows 62%, which is down years from 2021, where we reported 74%. But actually, this is because of the addition of I&M Uganda, which we were capturing for the first time in 2022. As they work, of course, towards offering a consistent offering similar to what we have in the rest of the group, we expect that number to rise. We look closely at the contribution coming in from new customers, and that is up 2% from previous year at 9%. And if you look at the contribution from our regional banking subsidiaries, that's also up. From a PBT perspective, that's up 2%. The summary financials, our assets have grown 5%, net loans and advances up by 13%, in line with the trends that we've been seeing in credit to the private sector. And in terms of profit before tax, that's up a strong 21% at 15 billion shillings. We remain well funded. We've got strong liquidity and are adequately capitalized, and you will see that from the ratios in the panel on the left. And from a shareholder value perspective, our return on equity is up 3%. Always great to see that. And from an earning per share perspective, that's up 38%. Not quite mirroring the rise in dividend per share, which I'm sure you'll be happy to see has gone up by 50%. So that's a summary number, but how did we actually do it? We'll come to that in a minute. But I thought that it would be good for you to see what what we call our strategy house and what it really focuses on in terms of our strategy and in particular the pillars that we will be talking through in the subsequent slides on driving business growth, resilience, and optimization of our operating model. The panel that you see at the bottom really speaks to our focus on growing our customer base, how we ensure that we have efficient channels for reaching those clients, our focus on innovation, and ensuring that we build the right partnerships to be able to enable our strategy. So how did we achieve our results for 2022? Well, we focused, first of all, on keeping true to our strengths in the corporate space and in the corporate and institutional banking business. You will see that if you track back to 2020, we've grown by about 65% since that date. You will see that we had 5% growth year on year, underpinned really by the strong offering that we have in our corporate business. We are a leader in the trade finance space, and we have been expanding our coverage to look at new sectors, which include agriculture, oil and gas, and the public sector. We move on to the personal and business banking space. This has received a lot of attention under this edition of the strategy. And we have seen significant growth in our operating income in the personal business banking segment, where we've seen customer numbers grow by over 32,000 just last year. Operating income has gone up by 21% in the past year. We have seen new offerings that have come through. We've revamped our customer value propositions, and in the MSME space, introduced new offerings that support the ecosystem approach that we are looking at to underpin the growth in this segment. It hasn't been limited to Kenya, where we have seen introduction of unsecured personal loans. We've also done the same in Tanzania, and you will see the significant growth that we have shown over the past year, writing about 2 billion shillings in each market in Kenya shilling value, in terms of the value of loans that we have written over that period. We've also launched workplace banking, which is going to support the growth in the unsecured lending space in Kenya, and we will talk to that a bit later. So all of this has led to steady growth in our total income, and if you look at the numbers right from the initiation of the strategy back in 2020 under Imara 2.0, we have seen our numbers rise from 24 billion shillings in total operating income to 36 billion in the past year. And just year on year, that would be 20%. If you look at the split between the various business segments, you will see that the combined personal and business banking segments are now contributing 43%, corporate at 34%, and that speaks to a very strong diversification approach. And then when you look at our other income streams, which cover treasury income, rental income, dividends from other subsidiaries, that's now at 23%. So a strong diversification story there. And that is also replicated then when you look in our balance sheet composition. We still have dominance by our corporate and institutional banking business, which takes up 67% of the balance sheet right now. But that certainly has seen greater contribution coming from the personal and business banking segments. And we expect that as our different initiatives come into fruition, they mature, we're going to see a more even split between those two broad segments. So loans and advances, as I mentioned, growing by 13%. And that clearly aligns with what we've been seeing in our various markets as credit to private sector. If we could go back just one, you will also see the sectoral distribution on our loans and advances, and the focus on manufacturing, which we've had in our different markets, really reflecting the customer profile that we have, and of course the opportunities that exist in our markets. So all this has been done against a backdrop, of course, of strong and prudent management of the balance sheet. You will see that we have focused on maintaining asset quality. Our gross NPA ratios still at 10%, beating the industry, which is at 13% on average. And that has been a consistent story year on year. Our loan loss provisions in 2022 up from 21 at 13.7 billion, but reflecting really our focus on making sure that we have a prudent approach to covering emerging risks in the balance sheet. So our cost of risk at 2.3% is broadly similar to what we had in 2021. And more importantly, when you look at the coverage that we have from our provisions, that's comparable to last year at 55%. So if you look then at the net NPA, that comes in at about 2.7%, I think it is. 2.7. Yeah. Yes, exactly, 2.7%. Good. So the balance sheet is also very well funded, and you will see a better distribution on the funding side, so no dominance from any one sector here. And the 5% growth that we had in total deposits last year really well contributed to by the various segments. Now, we also look at the mix of our deposits, how much of that is coming from what we call current accounts and savings accounts, or CASA, and term deposits as well, and the mix has been improving. This reflects really the performance of our strategy on the transaction banking side, and we can see that there are greater balances coming in from the opportunity then to use our revamped platforms, our new features on our transaction banking platforms, and that is the driver of the CASA ratio. So it is our intent, of course, to maintain appropriate levels of liquidity in all our businesses, and you will see that we have adequate liquidity in all our different markets. Liquidity, remember, is useful for us, and what we want to really focus on is how well we deploy funding that we have available in what we would be considered real lending. And we feel that the level of liquidity that we have across our various businesses is adequate. And from a capital adequacy perspective, we look to keep sufficient capital to finance any growth that we are looking at through the year. But at the same time, in an environment where we see significant shocks coming in almost on an annual basis, it is important for us to remain adequately capitalized. And you will see as a result that we have adequate capital ratios relative to the regulatory requirement. And we consistently look at any additional capital that's required to support business growth in any of our markets. So this story of performance really has been supported by our transformation journey. And that journey, of course, means that we had to invest significantly in providing that capability. Under Imara 2.0, we have been focusing on digitization and also building out new businesses so that we can diversify our revenue streams and scale these business opportunities. So that means that we are going to take on increasing staff numbers. So you've seen from 2020, we've grown by almost 400 staff, reflecting investment in new capability, but also looking at staffing our new initiatives that we have. So that has also been complemented by the investments that we are making in technology, in our infrastructure to ensure that we are looking to the desired future state. And we have also been looking at office automation and efficiency through investments like we have on our Microsoft platforms. So collectively, we've spent over 2.3 billion shillings just in the last few years just to support all of these initiatives, and that is reflected in the cost-to-income ratio, and of course the rising cost through the period, split through the depreciation and amortization costs, but also through the other significant costs that come along with that. It has meant then that if you look at the platforms that we have built over that period of time, investments in our new card management system, we are seeing significant impact on the digital side. Our digitally active customers has risen from about 48% to 70% in 2022. The digital transactions are now at 76% from below 70%, below 68% previously. And the NPS from 47% when we started out on this journey to 62%. And if we look at Kenya alone, the net promoter score is at 72%. So that really spoke to our strategy, a highlight on our numbers. And we will now dig into the actual detail for the various subsidiaries. So if we look at the aggregate picture, and we had seen a snapshot of this earlier, net interest income up 10% at just under 23 billion shillings. Non-funded income up quite sharply to 12.7 billion shillings, up 46%. Overall total operating income was up 20%. Expenses we've just discussed at 19% up, but if you look at the profit then before our loan loss provisions, that's up 22% to just under 20 billion shillings. Loan loss provisions were up, reflecting our prudent approach to balance sheet management. So 25% up. And then when you look at the resultant numbers then in terms of profits, before we include the distribution from our joint venture in Mauritius, that's up 21% at 14.3 billion shillings. When you then add the distribution from Bank One, that comes in at 15 billion shillings, reflecting a 21% increase year on year on the PBT. And then on a profit after tax basis at 11.6 billion shillings, that's coming in then at 34% up year on year. So strong growth. On the balance sheet side, we had touched on this metric, so I won't go in detail through them, but I think the number that would be useful for you to see is the 10% increase in shareholder funds arising from our activities through the year. So the summary ratios for the group, strong liquidity, like I mentioned, the drop from 52% to 46%, of course, mirroring the greater lending that we were doing. We saw 13% growth in the loan book and shows the deployment of funding into the real sector. The cost to income ratio at 45%, still one of the best ratios that you can see in the banking sector. We've captured the gross NPA. Return on equity strong and up at 15%. And return on assets also up at 2.7%. So the other metric we hadn't captured there was the loan to deposit ratio, and that shows how well we are actually deploying our deposits into lending at 76%. Right, so if we go into the various subsidiaries, starting with Kenya, where the business contributed 82% to the group's PBT. While Kenya has been dominant, we have been seeing the subsidiary performance also starting to really come up. And so this is a snapshot of what the performance for Kenya has been, 16% up in terms of PBT year on year, driven by a good mix on the net interest income side and on the non-funded income side as well, where we've seen strong performance year on year. The returns on equity very strong at 18.3% and return on assets crossing the 3% mark once again at 3.1%. If we move to the balance sheet, you will see that Kenya's contribution to group assets is at 72%. And deposits here grew 3% year on year. Loans and advances showing 14% growth for 2022. Now, we did have some market impact. When you look at the macros, we saw interest rates that were increasing during the year, leading, of course, to higher costs of funds. And we saw a shift in the CASA mix from the 34% contribution from CASA in 2022, which was up from 31% in 2021. But we underline here that we maintain our strong liquidity and capital adequacy, despite all of the challenges that the market has faced, that we feel have shown the resilience of our business. On the Tanzania side, while we reported a loss for the year, we see that it contributed 6% to our banking subsidiaries' operating income, which is good. We have seen a sharp increase, of course, in our loan loss provisions, which was what was driving the loss for the year. But the underlying business performance is strong, and you will see that the operating income was up 14% year on year. The returns on equity, of course, dipping as a result, But the important thing, I think, to underline in the Tanzania space is that the underlying business is strong. We have had to do the cleanup that we did in 2022 on the back, of course, of regulatory requirements as well as prudence. But we have strong expectations of growth in the Tanzania subsidiary in the coming year. It also contributed 7% to group assets, and you will see the strong growth that we had on the deposit side as well at 14%. And we expect that this is going to be further enhanced by initiatives that we have in the retail space and, of course, investments in the digital banking or digital assets that we are deploying there as well. So turning to Rwanda, Rwanda is one of our more mature businesses, and it contributed 10% to group PBT. Operating income was up very sharply at 36%, underpinned really by the growth in the loan book that we had seen, as well as in customer numbers, and also the margins and the ability to really take advantage of the opportunities in the FX side and service levels improving, driving fee income. So we continue there, of course, focusing on efficiency, and further investments in our digital space are going to drive even higher performance we expect in the years to come. So PBT up 25% year on year. On the asset side, on the balance sheet side, it has contributed 13% to our group assets, and similar to Kenya, has seen deposit growth at about the 3% level. Loans, of course, have been supported by growth in the business banking segments. I think you will recall from past discussions that we've had that we've been using Rwanda to really spearhead our initiatives on the SME space, and the lessons that we are taking from there are going to be deployed in the rest of the group. And Uganda, a good story, first full year of the results being reported for the group. We had reported a loss the previous year. We are happy to report that they posted a profit in 2022 on the back of business growth as well as strong efforts on the recovery side. And we expect that the initiatives that they have undertaken to develop business and the investments that will be coming in on the digital banking platforms are going to further support the underlying business in Uganda. It contributed 6% to our group assets, and deposits grew by 13%, showing really good recognition of the I&M brand in one of our key partner markets for our home markets of Kenya. In Mauritius, where we have our joint venture, this contributed 4% to our group PBT. We talked about the distributions that came from the JV. On the operating income side, their performance was strong, up 8% year on year, and the transformation that they'd been undertaking, the de-risking that they'd been doing over the past few years, showing really some strong dividends in terms of the loan loss provisions, as the cleaned up book really now generates the returns expected. So PBT up 4% year on year, and we expect that as the expansion of the balance sheet along the new focus areas following the de-risking that I mentioned, as that continues, we expect to see even greater contribution coming from the balance sheet side. And of course, from the fee income side, the advisory work that they do, the structuring work that they do is also going to be contributing to the fee line. So balance sheet growth following the de-risking, you will see loans and advances up 26% year on year, and deposits up 10% for the year. Again, just like the rest of the group, showing strong capital and liquidity ratios, which will underpin growth in 2023. So a summary snapshot then of our group. So PBT up 21% at just under 15 billion shillings. Total income up 20% at 35.6 billion shillings. Cost to income ratio, one of the best ratios in the banking sector at 45%. Loans and advances up 13%. Customer deposits up 5%, and ROEs up 3% to 15%. Now, our strategy is delivered by people, and it is important that we share what we are doing to make sure that we have the right environment where our people feel that they're empowered to work. We launched our cultural transformation project back in 2021, and in 2022 we really worked to embed what we call Pamoja, our cultural transformation program. And the coverage has been great. The reception from our staff has been great, and we expect that this is really going to form the basis on which the next transition of our strategy is going to see how our people really transform the business. We have also been looking at talent management. We want to make sure that we are investing in our top talent. We rolled out high potential and manager excellence programs across all the entities within the group. We're focusing on developing our leaders, particularly in the middle leadership levels, so that we can make sure that we have continuity in terms of succession, and that we have the right kind of leadership even at the top to drive the strategy. This shows in our employee engagement scores. We always listen to the voice of our staff, and it came in at 74% last year, showing very high engagement across the entire group. So really a statement of how focused we are on upskilling our teams to make sure that they can deliver the strategy for the group. We are also very clear that when looking at our strategy, when we're looking at the returns that we are delivering, that these are sustainable. So our strategy is underpinned by making sure that our performance is sustainable. It is important that we are aligned to what our customers expect of us in an increasingly discerning environment for doing business. They want to see that we are not destroying the environment as we go about our business. They want to see that we are in tune with the social imperatives that are in each market in which we operate. It is clear that in an environment of doing business where we have a very high percentage of youth, we need to be able to be relevant to our communities. We want to be able to help create jobs. And that comes through making sure we can partner with others to support all of the different environmental, social, and governance initiatives that are critical to doing business right in our chosen markets. So we have been spearheading this in Kenya through our I&M Foundation, and our 4 pillars we've discussed before on environmental conservation, economic empowerment, education and skills development, and then enabling giving. And if we just highlight a couple of things, we talked earlier about the worst drought we've seen over the past 40 years. We have been supporting the provision of relief packages to vulnerable communities, especially in northern Kenya. We've been looking at how we can provide clean water to those who do not have it. And on the education side, we continue to support the access to education by those who are disadvantaged. And we remain one of the biggest providers of scholarships through the Palm House Foundation. So just on the environment side, We have been working with several implementation partners, the KCDF, to help us really complete our intervention in different parts of the country in Kenya. And we've, through our program for planting trees in different parts of the country, we have been setting up nurseries through partnerships with schools and making sure that our ambition to grow trees sustainably is maintained. So even through the drought, we were able to replenish trees that had been planted. So in looking at how all of this then hangs together, we had discussed our shareholder metrics. So the EPS at 6 shillings 80 cents is very strong, up 38% year on year. Dividend per share up 50%, representing one of the highest increases year on year within the market. If we look at our dividend yield at 13%, we feel that is also one of the strongest that we have seen so far reported within the marketplace. And while we recognize the challenges in the stock markets and their ability to really reflect the value of the businesses that are listed on the exchange, we see that the current price to book ratio at 0.4 times is something that I know analysts are going to be looking at in great detail, but we will see that our book value per share is up 10% year on year to 46.30. Good. So on the outlook side, just a recap of what we are looking at in our strategy. For Imara, we are in the last year, the final year of our strategy. We are looking to continue leveraging on our strengths in the corporate space, making sure that the investments that we are making in technology underpin new revenue lines, as well as remove any bottlenecks to doing business within our corporate space. And through the personal and business banking expansion, we are looking at how we can increase coverage for the customers we do business with in these areas. We've talked about the MSME initiatives in various markets. And then we also want to make sure that the investments we're making on our platforms are underpinned by digital investments and are helping us to really strip out cost strategically across the group. So in summary, looking at the metrics on the right, just recapping that is what we are focused on for 2023. Good. Before we move into Q&A, I'll just ask Gul, who's joined us in the Kenya business as the CEO, to just share a couple of thoughts on the outlook for the business.
Thank you, Kahara. Good afternoon, everyone. Very excited about this year. That we'll have an ambitious growth plan already set for the Kenya business, and the teams are fully focused on that. Particularly in some of the new areas which the bank's invested in over the last couple of years, on the digital and retail side. So we're making a big push on that, on our digital lending, also on our transaction banking services for small businesses, and also on our, again, lending for small businesses around stock financing, supply chain finance. All initiatives the bank has invested in already over the last year, but now we're finding good opportunities to scale up. We're finding good insights from our customers to help us adapt our products and really scale up. So excited on that part, and on our strong business of corporate and institutional banking, which has been a real strength for I&M Bank. A big focus this year is to focus more on the government sector, where we're a bit under par as far as a penetration perspective, and also on oil and gas. So looking forward to making progress on those areas of our corporate institutional banking. Thank you, Kara.
Thank you, Gul. Right, so shall we get to Q&A?
Great. Thank you very much. Maybe before we start, we have a panel in place, as you can see. So I'd just like to make a quick introduction of the rest of the panelists. Starting from the far left, Gauri Gupta, our group group general manager for corporate advisory. Amit Biddev, our group CFO. And then on to our right, Rocky Olonde, who is our group strategy. So we have quite a few questions in place. I'll just start with what we received on email. These questions came from Old Mutual through Steve Maleche. The first question is regarding our strategy in Uganda. It is a small market, and I&M doesn't look different. So what is our strategy in Uganda going forward? Kihara, if I may ask you to take that.
Thank you, Steve. So yes, indeed, we have now been in Uganda for 1.5 years. A lot of focus so far has been on addressing some of the challenges that we had seen getting into the business, and some of which had been shared with us as key focus areas by the Bank of Uganda. So that means investing in platforms. So we are going to be doing a replatforming in the coming year. We are also looking at revamping the digital services that we offer, so that even that's going to be coming shortly as well. But our focus in Uganda is also driven by the corridor, the trade corridor that we have with Uganda. And one of the first things that we did when we went into that market was to look at our customers who do business in Kenya and Uganda, and making sure that we can engage with them on the ground over there. It helps with optimized use of capital, but at the same time, it makes sure that we are understanding their needs across the geographies. Now, in each of our markets, we look to get scale. And when we say that our aspiration is to be Eastern Africa's leading financial partner for growth, we are looking at how we can position ourselves in each market to be a leading bank. So we target to be a tier 1 bank in each market, and to also get to 5% market share if we can. And that will be through principally organic growth, but we also look out for any opportunities on the inorganic side. So right now, focus is on making sure that we have the right culture aligned to what we have across the rest of the group, that we have similar level of platforms so that we can ensure that the customer experience is seamless, and making sure that we build the capabilities that we need for the opportunities that are being highlighted in Uganda, particularly supporting the corporate business side, and of course the opportunities that we are seeing in the SME and retail side.
Great, thank you. I've got 3 more questions from Steve. So on Mauritius, is the profitability a one-off post-recovery? Is it one-off because of the post-recovery? And how sustainable is this profitability going forward?
So, Gauri, I'll ask you to cover that. You're more familiar with the de-risking and what it is leading to. But please cover that.
Yeah, so the de-risking was both on the assets and the liabilities side. It was following some internal exercise that we did in terms of our portfolio. So that's now been completed and behind us. On the recoveries, what we saw was in 2021, which was from some of the large losses that we incurred in 2020. I think these were some of the international names which we had discussed at our previous investor forums, and we managed to recover a portion of this in 2021. So that was a one-off, but I think now it's back to business as usual, nothing significant loss or recoveries that we would see. Some, unusual or exceptional ones.
Yep.
So there's a question on cost of risk. Is it rising because of new loans, or is it because the loan growth is slowing down, meaning that the cost of risk is being affected by the older book? So this is a general question around the cost of risk across all our markets.
Well, so I think in different markets we have different drivers for what we are then capturing as provisions. Certainly in Kenya, that has been partly driven by the loan book growth, so 14% growth in our loan book there. But at the same time, we always constantly look to where the strain is coming from in our loan book. So we take then a prudent approach to make sure that we are not seeing any spikes in our loan loss provisions. And so that has been one of the drivers in the Kenya space. In other markets like Tanzania, we discussed it in greater detail. There is some impact from timing, because some of the clients who took accommodations during the COVID period are only starting to manifest some of the underlying challenges. So again, prudently, we wanted to take the approach where we are not getting surprises later. So that provisioning is driven by that. In Uganda, we had more of recoveries happening, but at the same time, we're also looking at the book we inherited and the book that is growing. You saw the strong growth, 13% in that market. And we've just discussed what de-risking was doing for Mauritius. So that translates then to comparable year-on-year risk, but it's a mix of drivers.
Okay. Thank you. Question on acquisitions. Would I&M look at country-specific ones? That is it a bank in Kenya, Uganda, or any other geography? Or are we targeting a larger multi-regional outfit across several geographies?
Right. So we state in our aspiration that we want to be Eastern Africa's leading financial partner for growth. And those words are carefully chosen. So when we say Eastern, we are really saying that while we have our home market in Kenya, we are also clear that we've got adjacent countries that do business with us. Our customers do business in these adjacent countries. And typically, they want a name that is familiar to them when they're doing business in those countries. So we look out for opportunities as they arise. We will also go out deliberately to look at opportunities in markets where we feel there's potential. So that's really the approach. Gauri, do you want to add anything there?
In the markets where we are present, I think we are always looking to scale up. So when opportunities arise, whether in Kenya, Uganda, Tanzania, we continue to look at them. So yes, both. The short answer is yes. Other geographies as well as existing.
Yep.
Okay, thank you. So question from Miten Dutia. Good progress, but a long way to go to achieve a reasonable ROE, ROA. What are your plans and targets to improve these to the levels of what the industry leaders have in terms of their ROE and ROA metrics?
Good, yes. So the ROE question is always an interesting one. And just yesterday we were discussing whether ROE also reflects the maturities of markets. If you look around the rest of Africa, you will see markets where ROEs are in the 40% region. We have seen the evolution for the Kenyan market as a whole. We've seen ROE for other sectors in Kenya being significantly higher. But banking has been around for a while. Now, if you look at our specific competitors, the makeup of the balance sheets that they have, and the ability then to amplify returns because of any market dislocations, you will see why that ROE will differ from bank to bank. So what do we do about that? We feel that We focus on innovation, we focus on capital optimization, we make sure that we diversify our revenue streams, and ultimately that combination is going to lead to any alpha that we get from an ROE perspective coming through in new revenue streams and in doing existing business very well.
Okay, thank you. Question from Eric Mukaya. The FX income is 3 times, but is that sustainable now that the interbank has opened up and customers providing FX may consider other options that give them better KES foreign currency rates?
Well, thanks, Eric. So I think that the outsized performance for FX in 2022 was really reflective of what was going on in the global markets, and also the attempts by the regulator to ensure that you had a really measured approach to responding to these challenges in the markets. Are these sustainable? I think that if you look at the landscape of performance against the FX challenges, you will see that there have been winners and losers. I think you will see that customers who have been on the import side have had to deal with some significant challenges, and it's not desirable for them to be wondering whether or not they'll be able to meet their obligations on the import side as they arise. On the export side as well, yes, there may be windfalls that have come in the past year, but at the same time, they have to balance that against whether or not this is an aberration or when the right time will be to make sure that they are getting the shillings that they eventually will need in their markets. As the market players, as banks, we have to now look at the balancing of those two imperatives. It is always better for us to have a more liquid market, which gives us better price discovery, ensures that we have liquidity in the markets. And when we look at the recent initiative by the central bank to introduce the foreign exchange code, which has then been followed by the initiatives to get the interbank market restarted and eventually to get back to full performance, I think that we will see spreads narrowing, we will see liquidity improving, and what will really then drive FX numbers is going to be the innovation that different banks adopt, but at the same time, the service quality that they experience from their banks, supported, of course, by technology investments. And what we have been doing at I&M is to focus on all of those right, and ensuring that we are also in the leadership conversation when it comes to restoring the performance of the markets.
Okay, still from Eric. Since the Tanzania business has been struggling for years, what keeps I&M interested in TZ without considering a merger with another Kenyan bank subsidiary to reduce costs?
Interesting question, Eric. Now, when we say that the Tanzania subsidiary has been struggling over the years, actually that's not quite true. This is the first loss they've reported in quite a number of years. And indeed, the Tanzania subsidiary of I&M has been perhaps the only one that has paid dividends consistently over the past few years until the run-up to 2022 when we had to make these adjustments. Now, it is important for us to be in Tanzania. A lot of our customers do business there. As I said, they want to see a familiar partner in that market. And I think it is also critical for us to appreciate that Tanzania is a really big economy. And as the second largest in the East African space, we have to make sure that we are present as the opportunities from that market open up. Will there be opportunities for us to combine with other entities that perhaps give up their thinking in that market? Certainly, if that happens, we are always available to have that conversation, but we are certainly keen to be there for the long run.
Thank you. I still have two more questions from Eric at the moment. So the first one is, why is the statutory loan loss reserve to total shareholder funds so high versus most other listed Kenyan banks? Many, for example, ABSA Kenya are at 0% and most below 5%, whereas I&M Kenya is above 10%. Are there any specific reasons?
Good. Amit was wondering when he was going to speak, so.
Thanks, Kiara. Thanks, Eric. The loan loss reserve is as a result of the IFRS 9 and statutory discussions. In Tanzania, we've had to take extra provisions as per regulatory requirements, which has pushed up our statutory reserve higher than we had expected it to be. Going forward, as we align between IFRS and regulatory requirements, this number will drop. Thanks, Dibna.
Thank you. So two more questions around I&M Wealth Management. First is to speak about the numbers. So if we can speak about some revenue numbers and also the AUM numbers for I&M Wealth Management.
Okay.
Floris or Amit?
Eric.
Okay, I&M Capital. We launched the wealth fund last year. It's been about a year and a month, I think. We grew it from 0 to 3.7 billion in assets under management. In terms of their profitability, they made a loss of 6 million last year, and they're in a profit position this year of about 400,000. Their revenues grew 7x from 7.7 million to 56.7 million in 22. Assets currently under management are 10.4 billion as of December 22.
Okay, thank you. Another question from Miten. The cost to income ratio and the net interest margin ratio, not really industry leading compared to the top 5. What are the plans around this?
So cost to income ratio, I think, reflects where we are on our journey. We are investing in our people, we're investing in our platforms, and of course, the attendant revenues are also then to follow. We have, in the Kenyan business, we were reporting 33% cost to income ratio just a couple of years ago, now at 39% odd, just for 2022. Which reflects the heavy investments that we've been making, but we expect this eventually to come down. On the net interest margins, we talked earlier about the rising costs of funding in our environment in Kenya, and that in particular reflects the way the markets have been responding to the rising interest rates in global markets as they respond to inflation. You're seeing double-digit inflation in markets like the UK. So we expect some of this pressure to continue. And as we build out, you saw earlier the mix of our term deposits and CASA. And as our initiatives that we have put in place to support transaction banking pan out, we expect to see that the cost of funds is going to come down as our CASA balances go up.
Okay, thank you. So there's a question from Justin here. What do you attribute the slower growth in deposits to, and what is your outlook this year?
Yes, so Justin, the deposits, the pace of deposit growth is really aligned to the previous question that we've just addressed. So rising interest rates means that you're also seeing pressure from other markets coming to bear on our depositor base, looking for higher returns. You've also got, of course, locally, the higher rates that we're seeing in government securities as well. So it is something that we manage. So we've been shifting our focus to growing our current accounts and savings account balances and managing the costs of the deposits that we are getting on the term side.
Okay, thank you. Impressive strides made on the digital end. What is the percentage of the mobile to digital unsecured loans to your total loan books?
So on the digital loans, this really is a new area, right? So it's really just got off the ground last year, so it's still very early days. So as a percentage of total bank loans and assets, it's still very small. But the growth has been really impressive. The team has done a really good job in launching a digital unsecured loan product for our personal customers, also a digital unsecured loan product for our small business customers. And we're now just in the phase that we've got a lot of insights and we're looking to scale up. So still very early days, but this is one of our new growth business areas that we'll be focusing on for future growth.
Okay, thank you. We're at the top of the hour, so I'll just take one more question and then we can wrap up, but we will answer all of these questions on social media, whatever we've not answered so far. So maybe on the last question, what was I&M's exposure to the Euro bonds as of 31st December?
So we had a book of about $140 million as of 31st December.
Okay, great. Thank you very much. I'd like to say thank you to all our panelists for all the answers, to all the investors and analysts who actually joined the session today. Thank you very much. We look forward to having further discussions with you at our half-year results. And we will get back to everyone with the rest of the answers to the questions. Thank you very much and have a good afternoon.
Thank you, everyone.
Thank you.
Thank you.